Hey everyone, and welcome back to the channel. Today, we re-diving into a topic that I know a lot of you dream about. Early retirement. Not just retiring, but retiring early and living comfortably, all thanks to the magic of compound interest. Is it really possible to just live off your investment returns forever? The short answer is yes, and today I'm going to break down exactly how to figure out the numbers for yourself. So grab a notebook, because you're going to want to take some notes. First things first, let's talk about the core concept. Living off your returns. This month's UV. Build a big enough investment portfolio that the money it generates each year is enough to cover all your living expenses. The beauty of this is that you never have to touch your original capital. That principal amount just sits there like a golden goose, laying golden eggs for you year after year. This is the ultimate goal of financial independence. So, how much do you actually need? The most famous rule of thumb for this is the 4% rule. It's a classic for a reason. The idea is simple. You can safely withdraw 4% of your total invested portfolio in your first year of retirement, and then adjust that amount for inflation each year after. Historically, this withdrawal rate has been shown to have a very high probability of your money lasting for at least 30 years, and often much longer. In many scenarios, your portfolio would actually continue to grow. Let's make this real with an example. To use the 4% rule, you first need to figure out your desired annual retirement income. This is the most important number in this whole equation. How much money do you need per year to live the life you want? Let us say you do the math and figure out you need $60,000 a year to live comfortably. This covers your housing, food, travel, hobbies, everything. Once you have that number, you can work backward to find your target portfolio size. The formula is your desired annual income divided by your withdrawal rate, which is 4% or 0.04. So, for our example, you'd take $60,000 and divide it by 0.04. The result is $1.5 million. That's your magic number. According to the 4% rule, if you have $1.5 million invested, you can withdraw $60,000 every year and have a very high chance of never running out of money. This is also known as the rule of 25. It has just a different way of looking at the same math. Instead of dividing by 0.04, you multiply your annual expenses by 25. So, $60,000 times 25 equals, you guessed it, $1.5 million. It's the same destination, just a different road to get there. Whichever way you prefer to calculate it, the target remains the same. This number is often called your fee number, which stands for financial independence number. Now, I know what some of you are thinking. $1.5 million sounds like a huge, intimidating number, and it is. But don't get discouraged. Remember, this is a long-term goal, and the power of compound interest is what will help you get there. Every dollar you invest today is a seed that grows over time. Let's talk a bit more about why the 4% rule works. It's based on historical data of stock and bond market returns. A typical retirement portfolio is a mix of stocks and bonds. Over the long term, the stock market has historically returned an average of around 7 to 10% per year. After you account for inflation, which averages around 2 to 3%, you're left with a real return of about 4 to 7%. By only withdrawing 4%, you're giving your portfolio a buffer. In good years, when the market returns more than 4%, your portfolio grows. In bad years, when it returns less, you have that cushion built up from the good years to carry you through without depleting your principal too quickly. However, it's crucial to understand that the 4% rule is not a law of physics. It's a guideline. A great starting point, but not a guarantee. For those who are planning to retire very early, say in their 30s or 40s, a retirement of 50 or 60 years is much longer than the 30-year period the rule was originally tested for. Because of this, some more conservative folks in the early retirement community prefer to use a slightly lower withdrawal rate, like 3.5% or even 3%. Let's see how that changes the math. If you want to use a more conservative 3.5% withdrawal rate with the same $60,000 annual expense, you'd divide $60,000 by 0.035. That gives you a target of roughly $1.71 million. If you go down to 3%, your target becomes $2 million. As you can see, a lower withdrawal rate means you need a larger nest egg, but it also provides a much bigger safety net against market downturns and a longer retirement horizon. Choosing your withdrawal rate is a personal decision based on your risk tolerance. So, the big question is, how do you actually build this massive portfolio? The answer is simple, but not easy. Save aggressively and invest consistently. The key is to increase your savings rate as much as possible. This means tracking your spending, cutting out unnecessary expenses, and finding ways to increase your income. Every extra dollar you save and invest is a step closer to your goal. And where should you invest? For most people aiming for this kind of long-term growth, low-cost index funds, or ETFs, are a fantastic option. These funds track a broad market index, like the S&P 500, giving you instant diversification without needing to be an expert stock picker. You just set up automatic investments every month and let the market do its thing over the long term. This set it and forget it approach is incredibly powerful. Let's run a quick scenario to show you how compound interest works its magic. Let's say you're 25 years old and you start investing $1,000 a month. If your investments earn an average annual return of 8% after 20 years, when you're 55, your portfolio would be worth over $1.4 million. You would have only contributed $360,000 of your own money. The rest, over $1 million, is pure growth from compound interest. That's the power we're talking about. If you can increase that monthly investment, you'll get there even faster. Of course, there are other factors to consider. Inflation is a big one. The $60,000 you need today might be more like $90,000 in 20 years. That's why it's important to adjust your target number for inflation as you go. You also need to think about taxes. Your investment returns might be taxed, which will affect how much you can actually withdraw. Planning for taxes with a financial advisor is a really smart move. And then there are unexpected life events and healthcare costs, especially in early retirement before you're eligible for government programs. Having an emergency fund and a plan for health insurance is non-negotiable. So, to recap the steps to financial independence. First, calculate your annual expenses in retirement. This is your foundation. Second, choose a safe withdrawal rate, maybe starting with 4% and adjusting based on your risk tolerance. Third, calculate your financial independence number by multiplying your annual expenses by 25 or dividing by your withdrawal rate. Fourth, create a plan to save and invest aggressively and consistently, using low-cost, diversified funds. Finally, review and adjust your plan regularly. This journey to early retirement isn't a sprint, it's a marathon. There will be ups and downs, and there will be times when it feels impossible. But by having a clear number and a solid plan, you can turn that dream into a reality. It's all about discipline, patience, and letting the incredible power of compound interest work for you. I hope this breakdown was helpful and gave you a clear roadmap to start planning your own journey to financial independence. What's your fee number? Let me know in the comments below. I love hearing about your goals. If you got value from this video, please give it a thumbs up and subscribe for more content on personal finance and investing. Thanks for watching, and I'll see you in the next one.